Hey everyone, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I'm here with our Head of Research, Rayna. And this client briefing is going to be much more conversational, kind of podcasty in style. We just want to have a conversation about three big questions that they're on our minds and they're also on the minds of our clients because we're getting some incoming traffic on those questions. And those questions are, number one, is the Trump administration's policy shifting, or is it the same as it was, when he was inaugurated? The second is, are the market trends that we're seeing this year going to persist, or are we going to revert back to what basically was a consistent market trend over the past 7+ years with the US outperforming dramatically? And then the big one that's on everybody's minds is whether or not we're going to have a recession. So let's start with the Trump administration policy, and I think to kind of get the framing right, we need to go back to Trump 1.0 and at least discuss briefly about what the policy approach was that time around. And it was pretty clear to me that the policy approach during the first Trump administration, it was very much about economic growth, getting the economy humming, stocks up, that kind of focus. And we saw that because the economy was doing fairly well when Trump pushed through the big 2017 tax cut. So that's pro-cyclical policy, which is really a big boost to growth. And there was some trade tensions with China, but it was really focused on China, not the entire globe. But if we fast forward to this Trump administration, especially after his cabinet picks were in, it became pretty apparent that while Trump 1.0 was very good for Wall Street, this administration this time around wanted to focus on making it good for Main Street. And that really focused on a couple of main objectives. The first was to get the trade situation leveled out, level the playing field, to try and reindustrialize the US, both to bring jobs back to the US, but also for national security purposes. And then the second was to get interest rates lower, so that there would be an easier time for a lot of refinancing that needs to occur in the economy. And it was really a focus about getting the budget deficit under control as well. And they signaled that they were willing to take some economic pain in order to accomplish these objectives. So it was kind of a one step back, two steps forward approach. And you saw Elon Musk, come out full force trying to cut government spending, and that was projected to be $1 or $2 trillion in spending cuts. And then there was a lot of messaging around tariffs, and then we got Liberation Day, and everyone was like, whoa, this is way more significant than what we expected. And whether you're on the right or the left, almost every economic analyst that was watching that rollout basically said, well, the tariff rates that they came up with were very arbitrary and not indicative of what the actual tariff rates were across the globe. And the markets didn't react to that well at all. We saw a 10-11% drop in the S&P in 2 days. Peak to trough, the S&P went down 19%. But what was really unique is we saw the dollar going down. At the same time, bonds were going down. At the same time, stocks were going down. And the administration seemed to freak out a little bit. And there was rumors that Scott Bessent flew down to Mar-a-Lago and said to Trump, we got to change our harsh stance or things could blow up. And really, since that point in time, we've seen reciprocal tariffs taken off the map, at least for a 90-day window. There's been a detente with China, and the messaging has been much more pro-growth. So, what gives? Are we going back to Trump 1.0, or is this just a pause in the Trump administration's plan to do those objectives that they set out to achieve?
Yeah, well, the stock market is definitely looking like it's pricing in a return to the Trump 1.0 rhetoric, and there's a definite shift there, but still we're not seeing them abandon the ideas of the Trump 2.0 objectives. So just this weekend, the president tweeted how he has a focus on his objectives when it comes to trade still, and if he doesn't see more progress, he's willing to hike tariff rates back up. in about when those 90 days expire, or even beforehand if he doesn't see enough progress. So we're still in this limbo when it comes to that, and that's still very much on their mind. They do want to pull more manufacturing back into the U.S., but that's only one of the main objectives. I think there's also a focus on long-term debt when it comes to the Treasury Secretary, Scott Bessent, but now everyone is also looking towards the tax cuts. Yeah. And I think that's also supporting markets as well, because those are pretty substantial as it looks right now.
Well, before we leave the trade front, I think it's important to highlight that the current trade or current tariff levels are as high as they've been in 80 plus years. And if you look at kind of the path that tariffs have taken on a chart, you can see that they went from very low, at least relative to China, and then they went up to ridiculous levels that were not even meant to, add costs to trade. It was basically a trade embargo. And then we had the detente with China, and those levels came down. However, when you look at the levels that they are at today, across the globe, it's on aggregate higher than any level that we've seen in 80 plus years. So that's going to have some impact on the economy. The question is, when will it have the impact on the economy? Now, to the point about interest expense and the deficits and the total debt levels, I mean, things have gotten a little out of hand. COVID was a major shock to our overall debt levels. And we're sitting now today with $36 trillion in government debt. And because of the inflationary pressures that we saw in 2022, interest expense on that debt is now on the rise.
Mm-hmm. Yes, interest expense is now about 4% of GDP.
And I think we have a chart on that shows just how high that it's gone up.
Yeah, and that surge in the last couple of years is really mind-blowing. But on top of that, when you look at tax receipts, it's almost 30% of tax receipts. It's not something to just disregard. And I believe that's why they rolled out tariffs at the start of the new reforms, because they want to show that maybe they could pay for some of those tax cuts that they're trying to push through, and they're still trying to control the interest expense at the end of the day. But still, the focus from the bond market is on deficits, I believe, and inflation expectations, and tariffs have a big role to play there. Yeah,
the tax cut package that's working its way through Congress looks like it will add about $2.7, $2.8 trillion in additional deficits over the next 10 years. Now, a big portion of that is simply extending the Trump tax cuts from 2017. I think virtually everyone, Republican or Democrat, thought in some form or fashion that was going to occur. However, the offset could be a couple $1 trillion in tariffs. I can't remember if there was a bureau that rated how much we would receive in tariffs from the current levels, and it was about 2.3 trillion. So that could offset a lot of the tax cut, deficit spending. However, what's uncertain is whether or not the economy will still be able to grow at the same level if we have $2.3 trillion in tariff expense that is going to be distributed over a 10-year period.
Absolutely. There's so many moving parts. And I think that we can conclude that no, we're not back to Trump 1.0 completely. There's different objectives there. We have a different economy, different situation to deal with. But maybe Trump 2.0 would be softened now after seeing what sort of havoc markets can cause on everyone. And also, when you look at markets, Americans have about 48% of Americans have their savings tied to the stock market. So if you see the stock market tank by 20%, 30%, that's putting pressure on Main Street as well.
Yeah, and the marginal spender really is the wealthy in the U.S. That's where economic growth comes from, because the lower income consumer spends everything that they make anyway. It's trying to incentivize the wealthy to buy a second home or to go on an expensive vacation or to do whatever. And those people tend to focus much more on what's happening with their net worth statement. And if a lot of that is tied to equities and they fall, then that can have a negative impact on economic growth. Now, speaking of the stock market, we've seen a pretty wild ride in the last few months. And the trend that was in place from 2020, well, it was really 2014, but until the end of last year, but really magnified from 2020 until the end of last year. If you look at a chart of just how much the S&P has outperformed the international indexes, it's enormous. And this period has been termed American exceptionalism, where the US dollar went up, US assets were outperforming, international investors wanted a piece of the action, they funneled a bunch of money into the United States, partly to chase the tailwinds, but also as a result of trade deficits widening. There's sort of a mathematical process that forces dollars into US assets when we're running a big trade deficit. And this caused US assets to dramatically outperform. However, when you flip to what has happened so far this year, the S&P is underperforming quite dramatically. And like we saw during the height of the tariff uncertainty and market malaise, we had US stocks falling, we had US bonds falling, and we had the dollar falling at the same time, which typically only happens to an emerging market that's going through some sort of a debt problem. So it was a bit scary.
It's really indicative of outflows out of the U.S. markets. And when you look at international investors, there's analysts suggest that the big investors like pension funds, sovereign wealth funds were overwhelmingly allocated to the U.S. And they really benefited in the last 5-10 years when dollar is going up, their home markets are doing nothing, U.S. is really outperforming. So they're doing spectacular. They're not only gaining from the U.S. stock markets going up, but also by the currency appreciation. And now this year this is reversing. So is that going to incentivize them to take some chips off the table, to realize some gains on that front and balance their portfolios a little bit, even without any political pressure?
Yeah. And our counterparts that work with international clients have basically confirmed that a lot of the pension funds in Europe especially are going to be repatriating capital. Their U.S. allocation just got too big as a result of the dollar going up and the U.S. stock market doing so well. So if those flows start to come out of U.S. assets from international investors, that puts downward pressure on U.S. equity prices. Now, there are still plenty of flows that can go into stock markets in the U.S. from 401k plans and things like that, but you kind of lose the double tailwind effect. And part of the reason we've seen American exceptionalism is that U.S. corporate profits have been so good. But if you look at U.S. deficit spending at the government level versus the rest of the world, well, we've been running, in a lot of cases, double or even triple the deficits of a lot of other nations, and that money eventually finds its way into corporate profits. So if there is a push to try and shrink the deficit, that also would be negative for U.S. stock price growth.
Absolutely. And I think part of the reason why stock prices rebounded so much is because we saw the administration back off from that stance, at least for the time being.
Well, it got extreme. I mean, if you look at a chart of the U.S. versus the international markets over a long period of time, the outperformance got to basically 3.8 standard deviations, which, in mathematical terms is like a 1 out of 5 to 6,000 chance of it occurring. So, if you put that in trading terms, it's once every 20, 25 years.
And it stayed there for a while.
Yeah. So naturally, if there's a reversion to the mean trade, that could occur. However, the other thing that we need to make mention of is that there's a mathematical identity with international accounting or national accounting. And that is that if you have large trade deficits, you are spending more than you're making, and in order to finance that deficit, international money has to flow to the U.S. So if the Trump administration really is serious about shrinking the trade deficit, that will, by definition, by accounting identity, mean that less flows from international investors into the U.S. will occur. Yeah. And so I don't think that the Trump administration's goal is to have less purchases of U.S. Treasury debt, because we're going to be running larger and larger deficits going forward. So maybe they would be okay with a smaller trade deficit and less flows into the equity market.
Well, in economic accounting, there is an equilibrium between the capital account and the current account, and the two offset each other. And if you're selling goods to the U.S., you're receiving U.S. dollars, and in order to avoid that currency risk, you want to invest in a U.S. asset, usually the treasuries, sometimes equities as well. So there's really like a mechanical relationship there. I believe that in Stephen Moran's, he is the chairman of the Economic Advisors Council. He wrote a paper before assuming that post that suggested there could be a series of reforms to tackle several problems that the U.S. is having. And Scott Bessent, the Treasury Secretary, keeps referring to those solutions in his interviews. And one of them is to basically force foreigners to keep their Treasury holdings, and in fact to transfer them to a 100-year note that is not tradable. So maybe they expect for foreigners to neglect that relationship and to somehow avoid it, but that's still likely to put a lot of pressure on interest rates. If you're that foreign holder that now has to transfer their very liquid asset to a very illiquid asset that is very dependent on the U.S., like, aren't you going to try and take your money out now while you still can? Like, there's so many there's so much uncertainty, and I think that's what's putting pressure on interest rates too. But also maybe in the back of their mind, they have a solution to that question when it comes to trade flows, and still it puts a lot of pressure on asset prices and a lot of uncertainty going forward. Risks are rising for international investors in the U.S. for sure.
Yeah, but because the Trump administration has essentially incentivized or demanded that foreign governments invest more in their own defense and infrastructure, that is causing capital repatriation in and of itself. You know, Germany, which has always been very fiscally conservative, just in the last month and a half or so, changed their constitution in order to allow larger deficit spending on military and defense. So capital is going to be flowing back to Europe for those types of purposes, which should be bullish for the asset prices of European assets, and the same kind of thing is happening in Asia as well.
Yeah, of course, it's not going to happen all in one flush. Those are flows that take years to develop and to run their course. Yeah. So but there's a potential there.
Yeah, so there could be a situation where the enormous tailwind of the U.S. market over the past decade reverses and becomes a headwind, and you couple that with U.S. valuations being substantially higher than the rest of the world, and you can make a case that maybe the trend that we're seeing this year is going to stick around for quite a while, and you'll see international outperformance. Now, let's shift gears here and talk about the elephant in the room, which is the economy, and whether or not we're heading towards recession. When we were in the height of the tariff malaise and volatility, a lot of different investment banks came out and said, oh, the odds of a recession are now 60% or above 50%. And unfortunately, our own internal models were confirming that type of higher probability. If you look at our leading economic indicator model, it got a nice jump up after the election because it was assumed that Trump was going to follow very pro-growth policies. But then once Liberation Day came around and the tariff regime was rolled out, we saw a substantial decrease in that indicator, down to levels that typically have coincided with recession. Now, it's being driven by four main factors. You have production, consumption, income, and employment. And all four of those, unfortunately, are in negative territory, which is usually only happens when you're in a period of weak economic growth. Now, these are what we would call soft data, so they're based on sentiment and how people are feeling, not necessarily the actual investment decisions that are being made by businesses or the actual consumption decisions being made by consumers. However, the longer that people feel bad and CEOs have low confidence, the more likely that we would see a recession. So in my mind, yes, the sentiment data is bad. We're not seeing it in employment figures yet. The claims data is not ticking up. People are not losing their jobs, but we're also not seeing hiring. So it's this weird mix of people feeling pretty bad about what's occurring, but yet no real indication that the economy is substantially weakened.
Yeah, and I think there's one big factor here, and it's again the tariffs. Everything is linked together, and having a 90-day pause on the tariffs means that there's a lot of demand being pulled forward. If you're a manufacturing company in the U.S. that has components that coming from abroad, you're going to try and stockpile now, when it's basically the best case scenario going forward.
Yeah.
So I think that's definitely causing some a disconnect between the hard data and the soft data. But one soft data indicator that I think that we all pay attention to is the intention for CapEx.
Yeah.
Investments in the U.S., because when you look at the sustainability of economic growth going forward, you have to see that CapEx, and that's what they're trying to incentivize at the end of the day. So it's a big indicator of how successful those Trump 2.0 policies are also.
But I think on that point, you could look at the CapEx plans and say, well, the policies are failing. But if you're in the one step back, two step forwards mindset, then you could make a counter argument that says, well, of course you're going to see weakness initially, but down the road you're going to see the increase in reindustrialization. Now, whether that or not that happens, is yet to be determined. It's a long way out. But the fact that CEOs are feeling highly uncertain and CapEx plans are down in the short run raises the risk of an economic recession.
Yeah. Uncertainty is still out there. We don't know. Nobody knows where tariffs are going to land. And to circle back to the beginning, those tariffs are still higher than any point of time in the last 100 years. So are they going to impact future spending, economic growth?
Yeah.
Which sectors of the economy do better? Or, there's so many knock-on effects that we still don't have visibility on.
Yeah.
And imagine for a CEO that's trying to make the decision of making a big investment.
Yeah, which has, a 15 or 20 year shelf life.
Yeah.
It's tough to make that decision right away if you don't know what the future looks like. Now, eventually those CapEx plans will matter for the economy, because if they're not made, then you end up with supply constraints and just general weakness in construction activity. But this 90-day period where we're saying, oh, the tariffs are off for 90 days, incentivizes businesses to pull forward their purchases so that they don't have the risk of tariffs going up in 90 days. But what's stopping us from just continually doing that, every 90 days and pulling forward economic activity? I think what would eventually stop us is some sort of a CapEx cliff where the economy just grinds to a halt because of the lack of capital spending. But that's probably at least a year away. Mm-hmm. So you could see the economy remain strong simply because of the incentive structure that this 90-day pause is mm-hmm. providing. Now, what we don't want to see is a recession that's happening at the same time that inflation is going up. And there's been a lot of debate about whether tariffs are inflationary or deflationary. I think the inflationary side of the equation is pretty straightforward. It's just tariffs raise prices. So of course they're going to cause inflation. However, the deflationary side is more focused on the demand destruction that occurs. If prices go high enough, then people just simply can't afford the good. So it doesn't matter that the price is higher because the good doesn't sell. And then that causes pricing to come down. And what we're seeing across our inflation model and a variety of other models is that inflationary pressures are on the rise. If you look at a chart of, say, the Kansas City Fed index for raw materials versus producer price index, it's up a lot, and it's suggesting that we're going to see an increase in inflation in the short run. Now maybe it's an inflationary 2, 3, 4 months, and then a deflationary period because of demand destruction, but we just don't know yet. Yeah. But the kryptonite for the market is weak growth, high inflation.
Yeah, especially because it puts the Fed on hold. And they've indicated so far that they're not going to move because of those inflationary risks. They're not going to cut interest rates until they see material weakness when it comes to unemployment. And unemployment is still contained. Initial jobless claims are still contained, so we're not seeing that weakness. We can't expect cuts in the short term. So I think that the big indicator to watch here is interest rates. They're the material constraint here. Right now they're around 4.5%, which in the past was really a contentious level. 4.8 was like a high point. And if we see interest rates continue to move up, and that could happen for a variety of reasons, really. It could happen because of deficits now projected to be higher for longer. It could happen because of inflationary pressures, because of tariffs. It could happen because of outflows out of the U.S.
It could happen because growth is robust, too.
It could happen because of strong growth. So like there's so many reasons why that could happen, but it's really something that could put pressure on stock prices and on economic growth too, because now it's going to cost more for businesses to borrow.
Yeah. So I think if we put this all together, we still believe that Trump 2.0 policy is intact. It's just going to be rolled out at a less aggressive pace that hopefully should have less market impact. We do think that there are strong reasons why the U.S. exceptional tailwind is reversing and potentially leading to international asset outperformance. It's certainly been good for gold in both the U.S. exceptionalism and the unwind. Gold's been the one kind of amazing asset to own over this period. And then while we're concerned about a recession and we think the risks are higher than they've been in quite a while, until we see initial unemployment claims increase at a meaningful level, not just a couple thousand a week, then it's really hard to say that we are going to be in a recession or we're in recession. So that's probably the data point that we're watching most closely. But when you put that all together, it leads us to want to be more defensive and also maintain a pretty healthy international diversification to not just U.S. assets, but emerging markets, Europe, places like Japan, to make sure that we're covering all the bases for our clients' portfolios, so that if a certain pocket of performance starts to emerge, that we're not missing out on that piece of the pie.
Yeah.
Well, so that's kind of where we stand today. We continue to believe that a defensive posture through this uncertainty makes sense. It paid off in spades this year. Our portfolios really didn't fall all that much when the chaos was occurring. But we do have plenty of uncertainty ahead of us, and we'll be committed to keeping our eye on the ball and trying our best to figure out which way this is all going to go. But again, this is a highly uncertain period, but one that we feel like we're ready to tackle. So we'll see you next time.